Hey there, awesome accounting student. Mark Franke here. This is in the second video for chapter 3 on adjusting journal entries, and we'll also talk about the closing process. So this is a very good comprehensive problem in chapter 3, problem 3-5b, and this is in your book on page 136. Page 136. This is a brand new company called the Safe Storage Company, and they've given you a series of transactions that happened during the month. I'm not going to go through every one of them, but I am going to do a few of them just to get started. So transaction A is when they capitalized the company, $30,000 in cash and $150,000 in a building in exchange for common stock. So we're going to debit the buildings, we're going to debit cash, and we're going to credit common stock for $180,000. And we'll label that transaction A. Transaction B says, this is on July 2nd, they rented equipment paying $2,000 cash for the first month's July rent. So we're going to debit rent expense for $2,000 and credit cash for $2,000. Cash is going down and we're recording the rent expense. Transaction July 5th, the company purchased $2,400 of office supplies for cash. So we're going to debit office supplies, $2,400, and credit cash, $2,400. That's transaction C. So hopefully at this point you can make these entries and post them to T accounts. And when you do, you are going to get something that looks like this. So I have recorded all the transactions and totaled up each one of the T accounts, and I have prepared a trial balance, which is here. So when I take the balances from each one of the T accounts and list them out here, we get a trial balance. Again, this is chapter 2 stuff, so kind of a review, but I wanted to just get you started here. But what our focus here is to make the adjusting journal entries. So let's do that now. And they've given us some information on page 137, A through E. We're going to make 5 journal entries, and then we're going to post them into the adjustments column here and get an adjusted trial balance, and then prepare some financial statements. So I have set up these journal entries in this journal, and I'm going to walk through each one just to explain what they are. The first one is for insurance expense. We bought some insurance, $7,200, and we paid 12 months worth, which is $600 a month. But because they were bought on the 10th, we only have 2/3 of a month to expense, and the adjustment amount is $400. They've given you this amount, but I just want to show the calculation of how we got the $400. So debit insurance expense, $400, and credit prepaid insurance, $400. Prepaid insurance is an asset, it's going down. Entry B, supplies. We bought $2,400 worth of supplies during the month. At the end of the month, we went and counted the supplies on hand. In other words, those are the supplies that did not get used. Why? We still got them. We know we didn't use them. But we did use the difference, which is $875. Debit supplies expense, $875, and credit office supplies, $875. Office supplies is an asset. It's going down with a credit. Entry C, they just gave you the depreciation expense for the month. Easy. debit depreciation expense, $1,500, and credit accumulated depreciation, $1,500. Entry D. They told us an employee earned $100 of unpaid and unrecorded salary at the end of the month. So we're going to just debit salaries expense for $100 and credit salaries payable. Salaries payable and anything with the word payable is a liability. It's going up with a credit. And then at the end of the month, the company had earned $11.50 of storage fees that they hadn't billed to their tenant. So we debit accounts receivable for $11.50 and credit storage fees revenue. This is an accrual of revenue. We will get paid in the future, but we've already earned the money because of the month of July. Okay, so now if I go to the worksheet and I post these entries into my columns, entry A is a debit to insurance expense, $400, and a credit to prepaid insurance, $400. B, debit supplies expense, for $875, and credit office supplies, $875. Entry C, debit depreciation expense, for $1,500, and credit accumulated depreciation, $1,500. Entry D, debit salaries expense, credit salaries payable for $100. And our last entry, E, is a debit to accounts receivable and for $11.50, and a credit to storage fees earned. And just to make sure everything balances, I will total up the debit side, 4025. I'm going to total up the credit side, 4025, and we're in balance. So when I carry the totals across and make the effect of the adjustments, I get an adjusted trial balance on the right-hand side that balances at $192,550. Again, good practice to do this on your own, to just make sure you understand the flow of this information. So now we can prepare our financial statements. Financial statements, once we have made our adjustments, the financial statements will have all the correct balances. And we're going to do three. We're going to do an income statement, a statement of owner's equity, and a balance sheet. I have prepared these statements and I will show them to you, but if you want to pause the video and prepare some financial statements as good practice, and then resume the video and you can compare your answers to what I got. So here are the financial statements. The income statement, revenue and expense. We get net income of $27.25. I need to put a $sign up there. That's good. That $27.25 carries over to the statement of retained earnings. The statement of retained earnings. Little different than what we did in Accounting 100, but same concept. Because this is a brand new company, we didn't have retained earnings at the beginning of the month, or beginning of the month. but then we add net income of $27.25. The stockholders took a dividend for $2,000, which means retained earnings at the end of July is $7.25. And then the balance sheet has total assets of $180,825. Remember, we always have to separate the current assets from the long-term assets. That's a requirement of generally accepted accounting principles, or GAAP. And then we have one liability for salaries payable, and we have our equity section, which includes retained earnings that comes from the retained earnings statement, and our balance sheet balances. Dollar sign top and bottom. The income statement and the statement of retained earnings cover a period of time, and the balance sheet is as a moment in time. Let's see if I can get this centered properly. Let's move this in. There we go. There's the financial statements on one screen. So now we can make the closing entries. Let's review the closing entries. The entries are very, very similar to the closing entries that you learned in Accounting 100. But before we talk about them, let's talk about why. Why are we making these closing entries, and when do we make them? First of all, we make the closing entries at the end of the fiscal year. We're closing the year. This is not something we do every month. This is not something we do every quarter. We do it at the end of the fiscal year. Most companies end their year on 12/31, a calendar year, but not everybody. Major retailers, that's the last thing they want to do at the end of a calendar year, because it's the holiday season. They're busy. They don't want to do that. So Walmart, Target, Costco, they end their fiscal year at different times. Probably, I think Walmart ends their fiscal year in January or February. Apple ends their fiscal year at the end of September. Most school districts end their fiscal year at the end of June, because that coincides with the academic year. But the point is, it doesn't matter when a corporation ends its year. They have to make that election in the first year of operations. We're going to end our year at this point, but we only do this at the end of the fiscal year, so that the revenue and expense accounts will start over. If we want to look at the income statement for Apple computers, you'd see that year after year. In fact, let's do that. Okay, so here is the income statement for Apple, and they end their year at the end of September. So we can see 16, 17, 18, 19. You could see actually Apple revenues kind of dropped off between 18 and 19. My hunch is, I'm making this video at the beginning of September of 2020. At the end of this year, you'll see Apple's probably going to be close to, well, already the total is 273, so they'll probably end up around $300 billion. Apple is a rocket ship to the moon. So if you were to go back 10 years, you would see a huge trend in growth for Apple computers. The point is, at the beginning of every fiscal year, they zero out revenue, they zero out their expenses, so that they can start new and then have something to compare to. So the 4 steps. First, we close the revenue accounts to the income summary. Income summary is a temporary, kind of a fictitious account that accountants use for this purpose. We close the expense accounts. They're all debits. Revenue are all credits. Those credits are going to move to income summary. All the expenses are all debits. They're going to move to the income summary on the debit side. So close entry number 3 is to close the income summary, which is going to be net income. You have revenue and expenses in this income summary account, and then we're going to move it to retained earnings, which is where we want it. And then we close the dividend account to retained earnings because that's where our income and our dividends end up, retained earnings. The words retained earnings means the earnings that we have kept in the business. So if the earnings is net income and the amount of that income that we've paid to our shareholders through dividends is the amount we did not retain, so the difference over time, this is a permanent account, the difference between how much money we've made from the beginning of time minus all the dividends that we've paid out to our shareholders since the beginning of time is the concept of retained earnings. Okay, so I'm going to prepare these 4 closing entries as adjustments and for problem 3.5b, and I'll be right back. Here are 4 closing entries for this problem with Safe Storage Company. Now keep in mind, this was just for a month. We normally wouldn't do this, so this is just a textbook thing for illustration purposes. But our first entry, we're wiping out the storage fee account. It's a credit balance account, so we put a debit to it and we move those credits into the income summary. Closing entry 2 is to wipe out all the expense accounts. They're all debits, so in order to get rid of them, we have to put credits in there. And all of those debits are going to end up in that income summary, so that for journal entry or closing entry number 3 is going to be net income. We already saw that on the financial statements. It's $27.25. It's the difference between the $10,950 in revenue and the $8,225 in total expenses. Debit income summary, that zeroes that out, and we move that $27.25 into retained earnings as a credit, which makes retained earnings go up. And then our 4th entry is to record the dividends that were paid. So we're going to debit retained earnings. That makes retained earnings go down, and we wipe out the dividend account, which has a debit balance. So when we're done and we prepare a trial balance, we will have a post-closing trial balance that only has the permanent accounts, which are the balance sheet accounts, the assets, liabilities, and stockholders' equity. And here's what the post-closing trial balance will look like. No revenue, no expenses, no dividend. Okay, that's it for this one. Thanks for listening, and I'll see you again soon. Bye-bye.